He had no college degree, no financial training, no institutional pedigree, no verifiable client list, no investment track record anyone could examine, no employees beyond a small team of accountants and assistants. He ran what he described as a private wealth management firm that accepted only clients with a net worth exceeding $1 billion, managed what he claimed was $15 billion in assets, and charged fees that, by conservative estimate, generated $75 million a year. Nobody knew where the money came from. Nobody who mattered asked. That is the Jeffrey Epstein story that doesn't get told enough. Not the crimes; those have been documented, prosecuted, and litigated in courtrooms across multiple jurisdictions. The story underneath the crimes, the financial architecture, the institutions, the banks, the clients, the structure of a fortune that made everything else possible, and that, in almost every dimension that matters, remains only partially explained. This is that story. Epstein grew up in Brooklyn, the son of a Parks Department groundskeeper. He was gifted in mathematics, got into a good college, dropped out, and found his way to a teaching position at the Dalton School, a prestigious Manhattan private school, where he taught math to the children of the city's elite. One of his students had a father named Alan Greenberg. Greenberg was a senior partner at Bear Stearns. He liked Epstein. He got him a job. At Bear Stearns, Epstein was good, specifically good at something that would define his entire financial career: access. He was charming, he understood wealthy people, and he could offer them something that was not primarily an investment strategy, but rather a feeling: the feeling of being understood by someone very smart who operated at the very highest levels. He began advising clients on tax mitigation. He was introduced to CEOs. He built a network, lunching regularly with people who ran things at a pace and at a level that his actual title at the firm did not remotely justify. He left Bear Stearns under a cloud in 1981, an internal investigation into a questionable personal loan and tips to a girlfriend about stock IPOs, a concurrent SEC inquiry into insider trading. No charges were filed. He left. And then he did something that Wall Street has never fully been able to explain. He built something larger anyway. In 1988, Epstein founded J. Epstein and Company. Its stated business was managing money for billionaires. Its only publicly identified client for most of its existence was Leslie Wexner, the retail magnate who built L Brands, the conglomerate behind Victoria's Secret, Bath and Body Works, Abercrombie and Fitch, and Lane Bryant. Wexner's own financial advisor had warned him about Epstein before their relationship began. "I smell a rat. I don't trust him." Wexner ignored the advice. He not only hired Epstein, he granted him full power of attorney over his entire financial life. That power of attorney was total. Epstein could hire people, sign checks, buy and sell properties, borrow money, and execute legally binding decisions on Wexner's behalf. He used it. He acquired Wexner's Manhattan townhouse, which would later be appraised at more than $50 million. He managed the building of Wexner's yacht. He made financial decisions across Wexner's empire and in the process built his own. Epstein's financial trust company, the entity that managed Wexner's money, generated approximately $300 million in fee income between 2000 and 2006. When Wexner eventually fired Epstein in 2007 and later accused him of misappropriating tens of millions, the same firm's reported fee income collapsed to a few $1,000,000 annually. The magnitude of that drop tells you something about what the business actually was: not a diversified wealth management firm with dozens of clients and a robust investment operation. A relationship. One very powerful relationship, generating an extraordinary amount of money and a supporting cast of mystery, because Wexner was the only confirmed client. There were others, Epstein claimed. A financial profile from 2002 described him as managing $15 billion for a client list of unnamed billionaires, operating with a staff of 20 accountants, making all the investment calls himself, with no analysts and no portfolio managers. Wall Street insiders who knew him described the situation as one that didn't make sense. It's just not typical for someone of such enormous wealth to all of a sudden give his money to some guy most people have never heard of. A recent New York Times investigation described his early rise as built on scams, schemes, and ruthless cons, a pattern of deception that nevertheless convinced sophisticated people to trust him with extraordinary sums. The most recent documented explanation of his later wealth centers on a second major client relationship. Leon Black, the billionaire co-founder of Apollo Global Management, one of the largest private equity firms in the world. Black paid Epstein an amount that court filings and investigations have established at more than $158 million for what was described as tax and estate planning advice. The U.S. Virgin Islands government later sued Black separately and reached a $62.5 million settlement with him. The scale of what Black paid Epstein for advice has no clean parallel in the financial services industry. Now, the banks. From 1998 to 2013, Epstein was a private banking client at J.P. Morgan Chase, not a standard client, a private banking client, the division of a major bank reserved for clients of significant wealth, where a dedicated relationship manager handles your account personally and the normal rules of retail banking do not apply. J.P. Morgan knew about his 2008 conviction. The conviction was public. The guilty plea to soliciting a minor for prostitution was in the public record. The bank's own internal systems flagged his account activity as suspicious. Large cash withdrawals, wire transfers to a network of trusts and female beneficiaries, patterns that the bank's own compliance processes were designed to identify. Internal emails, later produced in litigation, showed employees raising concerns. Those concerns were reviewed. Epstein remained a client. J.P. Morgan kept Jeffrey Epstein as a private banking client for 5 years after his 2008 conviction. In 2023, the bank settled a class action lawsuit brought on behalf of Epstein's victims for $290 million. It separately settled with the government of the U.S. Virgin Islands for $75 million. It admitted no criminal wrongdoing. In a statement, the bank called Epstein's behavior monstrous and said it regretted the association. When J.P. Morgan finally severed ties with Epstein in 2013, the relationship manager who had handled his accounts, a man named Paul Morris, left J.P. Morgan and joined Deutsche Bank. In the spring of 2013, Morris pitched Epstein to Deutsche Bank's senior management as a new client. He described the opportunity in an internal email that was later produced in litigation. Estimated flows of $100 to $300 million over time, possibly more, with revenue of $2 to $4 million annually. Deutsche Bank said yes. From 2013 to 2018, Deutsche Bank opened more than 40 accounts for Epstein. It processed millions in transactions that regulators later described as suspicious. Payments to women classified as tuition fees, large cash withdrawals structured specifically to stay below the thresholds that trigger automatic reporting requirements, a practice known as structuring, which is itself a federal crime. The New York Department of Financial Services investigated and found the bank's conduct inexcusably deficient. In 2020, regulators fined Deutsche Bank $150 million. In 2023, the bank settled a class action with Epstein's victims for an additional $75 million. In total, Deutsche Bank's relationship with Epstein cost it more than $350 million. Then came Bank of America. In March 2026, Bank of America agreed to pay $72.5 million to settle a lawsuit alleging it had ignored suspicious transactions linked to Epstein, including a $170 million payment from Leon Black processed through a Bank of America account for purported tax and estate planning advice. The bank settled without admitting wrongdoing. 3 banks, 3 settlements, more than $400 million paid to victims of a man every bank knew was a registered sex offender. Not one executive at any institution was criminally charged. Here is what the financial network actually looked like. At the center was Epstein, a man with a talent for making powerful people feel that he understood them better than anyone else did, and a willingness to use whatever he understood to bind them to him. The money flowed through a web of trusts and offshore entities structured to obscure ownership and complicate investigation. He took advantage of tax incentives in the U.S. Virgin Islands, where he based his financial operations that, according to reporting, may have saved him as much as $300 million over roughly 20 years. He operated in the gaps between jurisdictions, between reporting requirements, between what a bank was required to notice and what it chose to. Around him was an infrastructure of enablers, not people who knew what he was doing in full, perhaps, but institutions that processed the money, asked the minimum required number of questions, and continued the relationship because the relationship was profitable. Banks that flagged suspicious activity internally and then continued banking the account. A financial system that is designed structurally to service wealth rather than scrutinize it, because scrutinizing it loses clients, and clients are the business. The fortune he built from that infrastructure at his death in 2019 was valued at approximately $577 million. It included a Manhattan townhouse worth more than $50 million, a Palm Beach mansion, a 7,500-acre ranch in New Mexico, an apartment in Paris, two private islands in the U.S. Virgin Islands, a private jet, a fleet of vehicles, and an investment portfolio that has still not been fully accounted for in any public document. The victim's compensation fund established from his estate has paid hundreds of millions to more than 150 claimants. The legal process that produced those payments took years. It required lawsuits against the banks that serviced him, the individuals who paid him, and the institutions that accepted his money and his philanthropy. It required the women who survived to file complaints, give depositions, and submit to the machinery of a legal system that, when he was alive, had already given him one of the most favorable plea arrangements in recent American history. Here is the structural truth of the Epstein financial network. It was not exceptional. It used ordinary tools, private banking, offshore trusts, tax incentives, power of attorney, philanthropic donations, advisory relationships that are available to any sufficiently wealthy individual and serviced by the most mainstream financial institutions in the world. What was exceptional was the scale of what those tools enabled and the length of time they functioned without meaningful interruption. The institutions that serviced his accounts were not rogue operations. They were JP Morgan Chase, Deutsche Bank, and Bank of America. The advisors who processed his transactions were licensed professionals. The law firms that handled his legal matters were legitimate practices. The universities that accepted his donations were elite institutions. Every component of the support structure was recognizable, accredited, and functioning exactly as it was designed to function. That is not a defense of what happened. It is a description of how it was possible. The money didn't make Jeffrey Epstein, but the money made everything else harder to stop. It paid the lawyers who negotiated the 2008 plea deal. It bought the properties that created the infrastructure. It funded the philanthropy that purchased the legitimacy. It maintained the banking relationships that kept the operation running. It attracted the clients whose names and connections made him untouchable in rooms where being touched should have mattered. There is a figure that appears in regulatory documents from the Deutsche Bank investigation that is worth sitting with. In the 5 years Deutsche Bank serviced his accounts, it processed payments for what it classified in its own records as tuition fees to women. It also processed more than $7 million in what appeared to be legal settlements, payments made quietly to people who had made allegations, and more than $6 million to law firms for what appeared to be Epstein's own legal expenses. The bank processed all of it, flagged none of it, and called the revenue for 5 years an asset to the institution. That is what the financial network behind Jeffrey Epstein actually looked like. Not a mystery, not a conspiracy, a set of incentives applied consistently by institutions that understood exactly what they were doing and chose the revenue over the question.